Hi, Charmaine.
Hello, Liz.
In a recent note to clients, you wrote about the wall of worry that U.S. equities have climbed since the market trough in March. Describe the uncertainty in markets and how U.S. equities have performed.
We are obviously in a tremendous moment of uncertainty. And when we're talking to our clients, they're always asking questions about things they're worried about. That's why we actually chose that title, to say that we understand all the various issues out there. There's uncertainty on infections, there's uncertainty on government policy, there's uncertainty on elections. There's so many uncertainties out there, and we understand people are worried. Yet the equity market is up 45% since its trough and over 1% year to date. So clients are asking, how is that possible that the market's done so well when there's so many uncertainties and so many things to worry about?
So this leaves many investors in U.S. equities wondering whether the rally is sustainable. What's your approach to this analysis?
One of the most important messages to our clients is that no one has a crystal ball. So basically, you're looking at probabilities. What's the probability of a mid-single digit return for equities? What's the probability of returns for bonds? And what is the likely expected return for cash? So based on monetary policy and what the Fed has very clearly telegraphed, we know that cash is going to be negligible returns with the Fed funds between 0 and 25 basis points probably for several years. So then you have a sense of very, very low anemic returns there. Then we go to bonds with the 10-year at about 60 basis points, 0.6%. You know that returns there are going to be negligible. And so then we turn to equities, and we're looking from our perspective in something like mid-single digit returns for the next several years. In fact, our colleague David Costin has put out a report saying he expects 6% returns, that's his base case, for the next 10 years. So in that regard, we're in line with having a similar view of equity returns. So we tell our clients, if you can look at 6% returns versus maybe at best 1% or close to zero for cash, then it makes sense to lean in towards equities, but recognize that it's not a smooth path. There's going to be a lot of volatility, and one should look beyond that volatility with a longer horizon.
So what is your recommendation to stay invested in U.S. equities based on?
In fact, for our clients to build the case up why we're recommending stay invested, we thought it would be very helpful to actually map out exactly the pillars on which this view was based on. So we start with, first and foremost, what is the healthcare outlook? Second, we thought we should discuss the economy and what are the key issues and the turning points. Then we thought it's important to recognize that while debt is increasing significantly and the debt trajectory is high, it's not something people should worry about so much now. And so we thought we need to discuss that. And then the final pillar was the uncertainty because of the political outlook in the elections. And so our view was that we needed to go through each of these topics in greater detail for our clients.
So give us a quick overview of the healthcare landscape. What are you hearing from experts?
So for this particular Sunday Night Insight and this view on climb wall of worry, we contacted Dr. Luciana Borio. She's an infectious disease specialist. She was head of biodefense at the White House under the Obama administration. And we had her help to explain what are the likely paths. And there was tremendous emphasis on the importance of wearing masks and social distancing. So at least we know that as long as people follow that guidance, the curve can be shifted back down again. And that means we don't have to lock down the economy in a meaningful way. So it's very important to recognize that while we still don't have therapies and vaccines, there are ways of making sure the economy doesn't have to go to a full lockdown again. And so that was very important value from her. The second issue is, what is the outlook for therapies and vaccines? And our view to stay invested in equities is not predicated on a vaccine in the fall. We actually say the likelihood of a vaccine that's going to be broadly used is not going to be something till 2021.
Let's dig into the outlook for the U.S. economy and financial markets. What's the latest data showing?
When we're looking at the economy, we look at a few sets of data. One is just basic economic data that might be available weekly or monthly, like non-farm payroll numbers, like ISM numbers, and they have shown a significant turn, whether we're looking at the unemployment rate coming down, whether we're looking at the ISM indexes recovering nicely above 50 in terms of some of the specific components. But we also need to look at high frequency data to see how the surge in infections is affecting people. So we look at Google and Apple mobility data, we look at data in terms of travel, we look at open table data in terms of people actually going to restaurants, for example, and that has actually stalled from its recovery and is actually trailing off a little bit. So we need to watch it carefully. It's not so much to be significantly worried about, but it's something we need to keep track of very carefully. On our calls, we had two guest speakers, Jan Hatzius, our chief economist and head of global investment research, and Jason Furman, professor at Harvard and former chairman of the Council of Economic Advisors. And they both agree that we're headed towards a mid-single digit downdraft for all of 2020 and a mid-single digit sort of 5% type recovery in 2021. So our recommendation to stay invested is based on that type of general growth areas.
And what about the US unemployment rate, where we saw a significant drop recently?
One of the big questions is, will this significant drop that we've seen in unemployment continue? And in fact, both our guest speakers have suggested that moving from, let's say, the unemployment rate at a peak of over 14% down to, let's say, 9% by the end of 2020 is the easy recovery. Going beyond that is going to take a lot longer because there are people who would have been unemployed for quite some time, and it's very hard for them back into the labor force and find jobs. It's going to be required to retrain some of these people. Some of those jobs will never come back. New jobs will be available. So the key is to think about the trajectory, and it's going to take several years, maybe till 2023, before we get to a mid-single digit, like 5% type unemployment numbers.
What did the experts you spoke with say about the need for further fiscal stimulus?
Across the board, everybody agrees that we need more fiscal stimulus in the US. And whether it's the president, whether it's the Senate, whether it's the House of Representatives, everybody is on board that we do need fiscal stimulus. The real question is, what is the number going to be like? The general consensus is the number is going to be around $1.5 trillion. That's what our colleagues at Goldman Sachs think. Other numbers out there are a little bit higher, some a bit lower, but generally that's the overall vicinity of the incremental fiscal stimulus. And the key is to make sure that we get it sooner rather than later. So as other benefits start to tail off and people talk about this cliff of, for example, unemployment benefits going off, we need to make sure that the new stimulus is here to support the economy. So our view is contingent upon additional fiscal stimulus.
Let's turn to US debt. A lot of concern, as you mentioned, about the rising debt trajectory. What are you hearing on that front?
We had two incredible experts actually on this topic. One was Bill Gale from Brookings Institution, and another was Maya McInnes, who is the president of the Committee for Responsible Federal Budget. And always focused on fiscal discipline. So they're not as if they believe in spending money indefinitely. And they were very also focused on the idea that we need fiscal stimulus, that at this point in time, this is money very well spent, but we need to have fiscal discipline after a few years. Most importantly, the issue that all this fiscal spending is going to inflation or will create a fiscal crisis in the US was actually negated by the two guest speakers. They said they don't think it's an issue in terms of people becoming concerned about the level of debt in the US at this point in time. And there was no concern that this would be inflationary. And so the idea is that while it increased the projections for debt to GDP significantly, it's actually not going to be an issue that the markets need to worry about. So as the markets climb the wall of worry, this is not something that people should be worried about now.
Charmaine, you also mentioned the US presidential election. How does that inform your analysis?
Just one more uncertainty to worry about in terms of what the elections mean. There are a few things that matter. One is when you have single party government across the board, so let's say the president, the Senate, and the House of Representatives all represent one party, typically neither the bond market nor the equity market actually like that. They tend to, on average, underperform periods when government is divided. So basically, the market likes a system of checks and balances, how money is spent, how much money is spent. And so as we think about the elections and the probabilities of a democratic sweep have increased, that's something to consider for the long run. The second component that people are somewhat concerned about is whether we're going to have a very aggressive tax plan, referred to generically as the Biden tax plan, and whether that actually will help or hurt the economy. So obviously there's a big fiscal stimulus and big plans for spending, and that has to be offset by some taxes in that tax plan. And one of the questions is, for example, if they increase corporate taxes, what's the hit to earn? What will that mean for the equity market? So that is something we're actually watching very carefully. One of our guest speakers, Jason Furman, talking about the tax plan, actually projected his view that the tax plan that he estimates at about 4 trillion is actually not going to fully pass. It's more like 2 trillion, and that will take some time. So it's not as if we're going to have a huge wall that we're going to hit in 2021. So it's something, again, to keep an eye on, but not something that's going to hold back the equity market from its underlying fundamentals.
So finally, Charmaine, what's the recap of your investment recommendation to clients?
The most important issue for our clients is to recognize that when there's this much uncertainty and this much volatility, they shouldn't be trying to trade the market. They're not traders. Our clients should be long-term investors. And as long-term investors, when the market is somewhat overvalued, as it is now, but not excessively overvalued, and the general direction of the economy, of monetary policy and fiscal policy is favorable, clients should stay invested. Now, what does it actually mean, stay invested? That means take the time to make sure the client has the right strategic asset allocation, and then whatever that equity allocation is, that is acceptable for their risk tolerance, that's where they should be. And so our recommendation is make sure you have the right strategic asset allocation, and at this point, be at that equity allocation, and not try to trade based on every headline. The market is just too volatile, and trying to trade it, clients can literally lose what they would make in 1 year in 1 day.
Thanks, Charmaine.
Thanks very much, please.